All right, so today we have Esther Chien from The Loan Story, a lender here in Silicon Valley. Esther, welcome to the show.
Thanks, Fernando. Really excited to be here, and thank you for having me as a guest.
My pleasure. First of all, let's start here. Tell us a little bit about yourself, how you got into mortgage lending, and what do you like most about it?
Yeah, good question. I got into the mortgage industry actually because of my mom, who is a seasoned veteran. Now, in the beginning, my background was in accounting and business
Okay.
economics. I was going to go into finance, and she's like, "Why don't
Mhm.
you just help me?" I was like, "I will help you, but I'm not going to go into the industry." I just
Uh,
had these some misconceptions about
okay, tell
people
us
who
about
work in
that.
real estate.
What were those misconceptions?
I thought that generally a lot of real estate agents, and I mean no offense,
Sure.
that was a misconception that I had back then, that they
Mhm.
were like just sleazy salesmen, who just
Right.
wanted to sell these high price homes. But after I got into the industry, I met a lot of really great professionals, and I really
Mhm.
respect what they do and how they do it. And so it ended up sticking. I do the financing side, but I love the consultation with clients. And I think
Mhm.
it's very, very gratifying to work with a client from the beginning to end, especially if they're like a first time home buyer. Yeah. What about you,
Yeah,
Fernando? How did you get into the
absolutely.
business?
Well, that's a good question. And I actually had just put out a YouTube short, Instagram reel,
Nice.
which explained, that I've been in the business for 15 years and how everything's changed over the last 15 years. But before that, I
Hmm.
worked for a home builder for 3 years. So if you want to count those 3 years, which I wasn't selling, then you could say 18 years, but I've been selling for 15 years. And I would say the reason I got into it was when I was working for the home builder. I actually got my real estate license during that third and final year that I was there, and I was hoping to become a new home sales rep, right? And I was thinking
Uh-huh.
that's great. I could just be there on site. People could come to me. I'll sell them the house. I don't have to worry about marketing or prospecting like we do what we have to do as a traditional real estate agent.
Right.
That didn't work out. They ended up hiring some other people within the sales staff. I don't know, secretaries or assistants, whoever was already part of the sales department,
Mm.
got the job that I wanted, right? And
Uh-huh.
so I went into general real estate back in 2008, which probably was the worst year to get started because that's the year that everything crashed, right? But from then to now, I would say what keeps me going and what keeps me excited about the business is how it's ever changing.
Yes.
And we talk about relationships a lot in this business. And I would say over the years, I've developed some great relationships with some of my past clients. And I think at the same time, me developing myself as a person, as a realtor, I'm attracting kind of a different kind of clientele today. People more or less that I could say friends of mine, people that I've hung out with, gone to dinner with. I've invited to different events. And that's kind of why I would say I'm enjoying it a lot more today than when I first started.
Yeah. Funny story. Yesterday, I was talking to a listing agent, and they said, "Oh, Fernando Alvarez, he went to my wedding." What a small world, right?
What a
But
small
that's
world.
awesome. Yeah.
Absolutely. And what's interesting about that is that you may have heard the stat, right? I don't know what it is for mortgage lending. It's probably something similar, right?
Hmm?
87% of people that get their real estate license leave the business within 3 years. I think
Yes.
3 years is the average renewal time. I know here in California, it's every 4 years you renew your license. But in Nevada, where I also have my license, it's every 2 years. So, 2 plus 4 is 6 divided by 2 is 3, right? So
Yes.
it's really interesting that people will go through the process of getting their license,
Hmm.
the different fees that they pay, background checks, taking tests, exams, and whatnot, finding a brokerage, getting started with it, and then more or less give up on it. Which if you stick it out, like anything in life that's worthwhile, it's going to be hard, right? And it's going to
Right.
take more than 3 years to consider yourself successful. There's always the people that can succeed in a couple of years and they figure things out, but it's almost like you kind of have to look at things like more or less like a marathon, which
Yes.
I ran one not too long ago.
Yeah.
It can be easy at first, but it gets harder and harder. But when you finally finish, it feels so rewarding.
Right. Yeah. I mean, you've definitely accomplished a lot, I think, in the last 15 years that you've been in the business. A lot of people, I think it goes to show that it's a very challenging business, actually, right? Competitive and challenging, but
Mhm.
definitely full of opportunities.
Absolutely. And opportunities is what we're going to discuss today. That is the main theme today that we're going to talk about is all these opportunities that are out there. I like to read the news. I go to yahoo.com and scroll and see what I read, especially when something's real estate related. I recently put out a Instagram reel that talked about, are we at the bottom yet? But there's a bunch of different stuff that I've read, that I've shared, and I'm sure someone like yourself also wants to see what's going on. But sometimes it can be skewed towards the negative because that's what gets clicks, right? That's what gets views. But we're going to talk about the positives out there. I mean, we can be realistic and say it's not all perfect and pretty because of interest rates and whatnot, but we'll talk about some positives. So in the past year, a lot has changed, right? As we discussed before, interest rates have increased quite a bit. Let's talk about a specific scenario, or not really specific because there's no really a name to these two people yet, but a theoretical scenario here. We have a younger husband and wife here in Silicon Valley. Let's say they make a combined income of about $200,000. They have a little bit of school loans, some car loans because they each drive and have to go to work, minimal consumer debt. They have a little money in the bank, but nothing, out of the ordinary. And they want to purchase a home. It doesn't have to be a single family home. It could be a townhouse or a condo, but something that they're happy with. Let's say either the realtor refers them to you or you come across them. How does that work to start step one to the time they become an actual homeowner?
So usually in our typical workflow, we usually start with a consultation. I think this is one of the most important parts because everyone can take numbers, input and plug and chug data, right? But really, you really want to understand people can have the same numbers in terms of qualification, but have completely different goals, short-term and long-term, right? So some are looking to just get into a starter home, but they eventually want to rent this out and move on to the next property. Some, they just want to get into a home that they're going to stay in permanently. They are not really having an investor's mindset of acquiring many more properties, right? So this is what we want to uncover in the consultation. And I think one very important part of the consultation is helping, especially the first-time home buyers, to see the opportunity that's there, right? I totally understand because I myself am incredibly conservative. I am very risk averse, okay? So if you're talking about making a huge purchase, like the biggest purchase of your life, I'm well, let me take 10 steps back, right? Let me check out all the numbers. And then you come back and you're well, the numbers don't make sense, right? Let me just rent forever, especially in the Bay Area. But having been in the industry for 10 years and seeing how real estate builds wealth for myself and as well as my clients, I am a firm believer of helping a first-time home buyer take that step, right? And I think a lot of this is almost like a mindset thing, right? Of course, let's talk about what happened in the past year.
Okay, let's talk about it. It's the elephant in the room, right? There's no way you can't talk about the future without talking about what has occurred in the past year.
What's happened in the last year? Yeah. I mean, we all came out of the pandemic, right? And of course, during the pandemic, it's full of uncertainty. But even then we were met with historically low rates. I mean, it was 2.5, 15-year at 1.99, that kind of deal, right? I mean,
free money.
Essentially. And so a lot of people took advantage of that, which was great, right? But now what about the new buyers coming onto the market? Now we're completely in a different landscape in a sense in terms of interest rates, because I know 3 months ago we hit a historical high of the last 20 years, which is we reached close to 7% interest rates. And this has never happened before, where you went from 2.5 to 7% in 1 year or a year.
Nearly triple.
Yeah, it's a 5% easily, 4 to 5% difference, which immediately people who qualified for something higher were dropped down in terms of what they could buy on the market, right? However, is there an opportunity there, you think, Fernando?
There definitely could be. And you know what I relate it to, Esther? I want to give you an example. So one thing I love sneakers. I wouldn't say I'm a sneakerhead because I don't try to see what the value is, and I don't try to buy certain sneakers to resell, but I like buying running shoes, basketball shoes, gym shoes, casual sneakers. But over the past year, there's been some sneakers that I've bought that I'm oh, wow, it's $10 off. And then next thing you know, a few months later, that same sneaker is like $50, $60 off, right? And I feel some kind of way like, man, I haven't even worn those sneakers yet, right? Like, and so you almost feel like, man, that's so unfair. That person got such a better deal than I did. And today's buyers are feeling that way those they got 3% interest. I see the memes out there where people are like, the person they got 2.7% interest rate, and they're acting like they're all high and mighty, right? Like, I got this crazy rate, and I feel so good about it. And obviously today, like I said, we're discussing how people, they have no choice, right? There's no way to make the rate what it once was. I mean,
Right.
There's some things we'll discuss a little later on as far as lender credits, but it can only bring in that so much, and the buy down programs, which are not permanent. But you're absolutely right. People today have to get adjusted to the market that we're in today.
Correct. And I think that, most people, it was such a sticker shock that it was hard to accept. So we saw everyone back off the market. But, on the flip side, what I would say is I think that prices are normalizing, which is a great thing for the market overall. I think like if we were thinking about how the market was in like May of 2022, it was crazy, right? I mean, people are offering like $2 million on a $1.4 million home. And it was like appraising, and they would purchase it for that much, right? Now, comparatively, I feel, and Fernando, you would know better than me, but I feel on average prices are probably at least 10 to 15% lower than what they were in the beginning of 2022. And so there's like almost, because of the interest rate increase, there's a small window where prices are leveling out, and I'm seeing that buyers are able to sometimes make an offer with contingencies, whereas we've just never seen that in the last 3 to 5 years, given how competitive the market is. And so there are also, I'd love to talk about some of the programs or changes that have come about this year that might benefit the first-time home buyer.
Absolutely. Let's talk about that. A lot of the people that I meet more often than not are first-time home buyers, or people that I meet maybe through an online lead source like Redfin or Zillow, or they referred to me by one of my past clients. And you have to start off with the educational portion of it. They've done some research here in Silicon Valley. They'll get out there and get informed. But there's obviously the nuts and bolts that we can help them with. So let's start talking about some of those opportunities within the programs that you're going to discuss.
Yeah, the whole gamut of products available, there are just a lot, right? I think one new thing this year is that if you're purchasing like in a conforming or high balance loan amount, which currently in 2023 is anywhere from the range of like 726 to 1.08 in terms of the loan amount. There is a nice thing rolled out for first-time home buyers who meet certain income limits. So for example, maybe I'll tell you kind of like a case that I just did where the buyer essentially, if you meet a certain area median income limit, for example, in Santa Clara County, you have to meet 100% of the area median income or below that. And because Santa Clara is a high cost county, actually they'll let you go up to 120% of the area median income.
What's the median income in Santa Clara County?
Yeah, I think the median income is around 120. I could be wrong, but the 120% would be 199,920, something like that. I need to double check on the exact number. But a lot of people, they're like, well, we make too much in the Bay Area. We're far from that. But actually 199 for someone who has a base pay of that amount could afford something, in terms of like maybe a condo or a small single family. So I had a client who the original market rate was around 6.25%. And because she qualified for that income limit and being a first-time home buyer who is buying her primary, she was able to reduce her rate by 0.5 to 0.625% immediately without having to do anything, right?
Now, is that subsidized, or how does that work?
It's not subsidized. What they want to do is, in a sense, in the past, what happens is if you have a lower credit score, you have less down payment, you're deemed as a higher risk to the investor. So in order to compensate for that risk, they're going to add an interest rate hit to your typical mortgage.
Okay, makes sense.
Now, because they want to give first-time home buyers an opportunity, especially to make it a little bit more affordable for them, what they're essentially doing is if you meet that requirement, they'll remove all the hits, which is great because let's say you have a 680 FICO score and that would have been a 0.375 hit on your rate. Now it's completely removed and you're put on an even playing field with someone who's at 780 credit score. Pretty nice.
That makes quite a big difference.
That's right. And if you had, let's say, only 5% down and compared to someone who was 20% down, well, now you have the same rate as someone who has 20% down. So
let me ask you a question about that. What about PMI? Are you still subject to PMI?
Good question. Good question. Unfortunately, if you are less than 20%, you still subject to the PMI, but at least the interest rate in terms of, could be anywhere from like 0.375 to 0.5% better easily.
Got it. Okay, cool. So yeah, let's talk about that situation where someone doesn't have 20% down and what are their options. You had just mentioned one of the options is this program that can bring them down to a lower interest rate. But as far as like someone that doesn't have that 20% down, I know this is pretty common. People talk about it a lot, but there are conventional 5% down, 10% down, or FHA programs at 3.5% down. Talk about some of those programs.
Sure. Yeah. So typically, I like to start with qualifying for the buyer for the best rate and the lowest payment, right?
Okay.
So we'll start out at conventional. If they can do 15, 10, or 5%, that will get them a pretty decent rate and they'll be paying mortgage insurance. Depending on the market, it's either baked into the rate where they're not paying mortgage insurance. That's called a lender paid mortgage insurance.
Okay.
And on the other side, they can pay for their monthly mortgage insurance. And that's called borrower paid mortgage insurance, which right now is pretty common. So if they have about 15% down, it's actually not, I ran a scenario and the mortgage insurance was about $75 or so per month. So not exorbitant. Now for people who don't have 5%, the next tier, perhaps like an FHA or government program with a 3.5% down. There also are programs for 3% down. I mean, where's the limit, right? That kind of.
Yeah.
Even if the buyer has no money, technically there are assistance programs from the government that can help you either pay for the down payment of 3% or help you with closing costs. So that commonly comes from Cal HFA, where they can get a second or third loan to help them with that difference that they need.
Got it. Okay. So as long as someone can make the payment, there is something that they can be put into essentially.
Typically, yes.
Okay. Let's talk about someone's conventional, right? They have a 20% down, if not more, but they're still wary of the rate for the reasons that we've discussed. There still are some options to bring that payment down a little further. Like one of them, for example, is asking for a lender credit from the seller. Is there a limit to how much you can ask, or how does that work?
Yeah, generally we'll help you find out where the limit is because due to compliance rules, you cannot pay exceeding 3% or of the loan amount in terms of total costs. So you would work hand in hand with the lender to determine what's the maximum buy down that you can get. So there are permanent buy downs, meaning a point buy down where it's all paid lump sum upfront and you permanently buy down the interest rate for the remainder of the loan. That's one way. And then there's a like 3-2-1 or 2-1 buy down, which I'm sure many have heard already, where the first year, the interest rate is bought down by X percentage, and then the second year, another percentage. The only caveat for that one is that you still have to qualify off the normal interest rate. So a lot of times in order to help you qualify for a higher purchase price, we use the permanent buy down in terms of the lump sum.
Got it. Okay. And you think right now people are preferring one way or the other?
I think it really depends case to case. If the issue with the buyer is like, well, I can afford this, but this payment is beyond my comfortable limit, then I would recommend the 3-2-1 or the 2-1 buy down. If it's because of qualification issues and we need to bring that rate down in order to qualify for something a little bit higher so they can squeeze into a property, then in that case, I probably would recommend the permanent buy down, the one time.
Got it.
Yeah.
And I mean, that just goes to show there are different options out there. And I would say from the real estate side right now, yes, we're starting to see certain homes being priced a little less than they were before, therefore driving up interest once again, like the situation that we were in a year ago or so. But there's still a bunch of homes that I'm still seeing out there that have been on the market for 30, 45, 60 days or more. And there's still some opportunities out there for someone to get in there, do three things essentially: get a home for less than list price, ask for lender credits from the seller, right?
Yeah.
And even have the seller pay some of the closing costs as
That's
well.
right.
So that's my next question that I wanted to ask you for these first-time home buyers that not only worried about their payment, the price they're paying, the interest rate. What about the cost that will take to actually purchase the home? What's something that they should be wary of, or, you know, if they feel taken advantage of? Like, what are some of those fees, or if they're being overcharged for something? What's something for them to be kind of cautious about when it comes to closing costs or lender fees?
Sure. I think one common thing, especially if buyers are going online to get a rate quote, a lot of times it advertises a great rate, but on the back end, you'll see there's a charge for points or additional fees. So if there is a lender that they trust, I usually always like, if, you know, even if my clients don't end up going with me, I'd love to be kind of give them a second opinion. Like, hey, I don't want you to be paying excess fees that you don't have to be paying.
Sure.
The one thing I would look out for is points. Unless you agree to paying points, if you got into an interest rate and you see points showing on the loan estimate, if there are exorbitant fees anywhere in terms of the lender's fees, like appraisal credit, those are things that we can also help you look out for. In terms of closing costs, I mean, in general, I would say, at least for California, it's 1 to 2% of your purchase price. In certain counties, it will be a little bit more. Of course, there are ways to help cover closing costs if we estimate, right? Like Fernando, you mentioned there are seller credits that you potentially could ask for. In this market, I'm seeing some of that be granted by the sellers. And then actually you could take a slightly higher rate and have the lender give you maybe a few $1,000s credit to help recover closing costs as well. So if people are comfortable, you know, in a high rate market, just because I feel like probably toward end, we have a good year end, we have a good chance of seeing rates come down. It doesn't hurt to kind of minimize the out of pocket and then refinance toward the end of the year.
Yeah, absolutely. I agree. And that's the thing, what a potential home buyer should explore all their options with, you know, everything included, all the different things that a person can do, because it's not so cut and dry as sometimes they make it seem, right? It's essentially a 3% earnest money deposit. It's 20% down. These are the fees. It's going to vary. And I tell some people when I'm talking about potential closing costs and fees and whatnot, I'll say it also depends on what time of the month you're going to close, right? Because there's some prorations, right? There's with taxes, with HOA, with you know, insurance and everything else. And so it could vary. It could really vary as well. Let's talk about this as well. Let's talk about some of the reasons for optimism, right? We've already discussed programs. We've taken certain people and talked about potential scenarios and whatnot. But over the next, say, 12 to 18 months, what would you say are some of the things that you're really optimistic when it comes to lending and real estate and homeownership overall?
I think I would be, I hope I'm right in saying that I'm optimistic about where mortgage rates will be.
Yeah, absolutely.
I think that come year end, as soon as we see inflation coming down, I think that we've maybe seen it peaked. So hopefully that just means that mortgage rates will improve. And overall, that means that affordability for everyone will improve as well. Of course, on the flip side, that means that everyone will be back on the market looking. So you and I will be very busy. But in terms of where the market will be, I don't think that prices, even if there is like this recession that everyone is talking about, right? Historically, other than, of course, you know, the financial crisis which was a fundamental housing crisis. Generally, in a recession, actually, prices have maintained their value. So I'm not too concerned about like a housing crash per se, and with prices coming down. What about you, Fernando? What do you see on the market in terms of what the buyers can hope for?
Yeah, that's a great question. I've had a couple conversations over the last few days that the clients I'm working with are pretty surprised with what's transpired. One
Mm.
comment from one client was like, I was surprised how quickly the market's picked up, right? And I
Yeah,
said, well,
yeah,
interest rates have ticked down a little bit. We're now entering, now we're not in spring yet, we're in February, but we're getting closer to spring.
right.
At the same time, we still have very low inventory. And a lot of sellers right now, this is the situation. Why would they sell a home that they have a 2.5 or 3% interest rate to move
Hmm.
into something that they pay 5%? So there's less homeowners that want to sell. They want to
Hmm.
hold on to those homes, right? Unless they have to
Yeah,
sell or, life situation or whatnot. So I think that's going to cause, again, I'm not trying to say that prices are going to skyrocket, but prices to be pushed up a little bit.
hmm,
Are we at the bottom? It's hard to say, but I'm starting to see activity that's telling me maybe we have hit the bottom.
yeah,
So going back to interest rates, again, they're right now maybe in that low fives, 5%, possibly can get under 5% at some point later this year. Obviously, you probably would know more than I would.
yeah.
I would expect I would expect there to be overall more activity this year than there was last year, because last year obviously it started in the way it's been most years, and then by the
Right.
second half of the year things got really slow, really slow.
Oh yeah.
But
I think
January, yeah, go ahead.
I think it was probably, if you ask like everyone into the
Yeah,
industry, it was probably the slowest time in the last like 20, 30 years even. So
I would talk.
definitely.
I would talk to some other mortgage lenders, and they would say, "Man, I don't have anything in the pipe right now." And it's like
Mm,
there's always
yeah.
something, right? But yeah, it was a very interesting year. But yeah, no, definitely, like I said, I think there's a lot of optimism within the next year. Now, the other thing too that I wanted to ask you too is you had
Mhm.
touched on it a little bit earlier today. For
Yes.
the most part, we focus on first time home buyers and how to get into a home and that whole
Mhm.
process. What about investing? Do you work with a lot of investor clients, or how are some of the ways that I guess you could say you could help investors or lenders can partner with investors nowadays?
Yes. Yeah. Investors is kind of the other half of my clientele,
Okay,
where
nice.
they have a sizable portfolio, and
Mhm.
it really depends. A lot of them, they really don't. I mean, they own like 20 plus properties.
Wow.
If you go through a normal loan, there's so much paperwork that you have to submit.
Hmm.
You have to verify your income, and you got to provide all the documents, mortgage statements, property tax, insurance for all the properties, right? So a lot of
Wow.
them are using much simpler products, as long
Okay.
as they can cash flow correctly. Basically, I don't know, you're probably familiar, Fernando. It's called a DSCR program.
Hmm.
Basically, they just qualify you based on the rent that you receive, versus the payment of the home. Now, there usually the requirement is it's got to meet a 1-to-1 ratio, like $3,000 rent
Sure.
and ITI, your mortgage, property tax, insurance. But now there are lenders coming up with all kinds of programs where you can go way below as well. So
Wow.
mean, there are a lot of opportunities, even if the numbers don't work out and you feel that it is an investment that makes sense for you.
Mhm.
Maybe you're in it for a long term appreciation versus just the cash flow. Then there are also definitely a lot of products coming onto the market. I think during COVID, a lot of these programs for either first time home buyers or investors got really tight because everyone's unsure about the future, right? But
Yeah.
now they're all kind of like coming back on the market. So I see a lot of new programs being released, and that will probably continue to be the case for the rest of the year.
That's great. I mean, I think when you think about building wealth, there's only a few ways you can do it. One is the stock market, which tends to be a slower and steadier approach. I mean, yeah, people can pick stocks, but usually when you just try to be a stock picker, you'll probably screw something up along the way, right? There's, I guess you could say, kind of aggressive alternative investments like cryptocurrencies and NFTs, and we've kind of seen what's happened with that market as well.
Yeah,
Um,
yeah.
you could purchase a business or invest in a business, but it seems like the most common way that people build wealth here in America is to invest in real estate. Would you agree?
Yes, yes. I personally have avoided checking any of my 401 this year. I'm going to stick to something that I'm comfortable with and I know
Yeah.
is a great hedge against inflation, which we've seen this year, which is
Mhm.
real estate. So, yes, there are definitely a lot of things. Of course, like everyone says you want maybe to diversify a little bit, but
Yeah,
real estate definitely is one of the most powerful ways to accumulate wealth.
absolutely. And
Mhm.
we were talking about this, I guess, a few days ago. You had mentioned that your company or your brokerage is getting licensed in Texas, and do you have
Yes.
licenses in other states as well?
Yeah, we're looking to expand state by state. We started with Texas, then we're going to go to
Okay,
Oregon, Arizona, Washington, maybe Florida. So
got it.
step by step. Yeah.
And those are the markets you guys have identified as where investors would probably want to purchase, or is it just
That's
generally?
right.
Okay,
First,
tell us
the
about
way
that.
that we came to that was our clients are already asking us, "Can you help me
Hmm.
do this loan in Texas? Can you
Hmm.
help me do this
Hmm.
loan in Arizona?" And it's so sad for us because we'd love to help them, but we weren't licensed in
Yeah.
those states. So now we're working on it.
Awesome. Awesome.
Yeah.
Well, Esther, I really appreciate your time today. I had a wonderful discussion. We talked about all these opportunities, different
Right.
loan products, uh, first time home buyers, investors, and everyone that you guys can help. How can they get a hold of you?
The best way to get hold of me is they can text me or call me on my cell phone. I'm gonna
Okay.
announce this
All right.
at
What is it?
510-552-9991. Of course, I'll share my email and everything, my website where you can reach me to schedule a consultation as well. But thank you,
Perfect.
Fernando, for your time. It's, I've known you for so long. It's been great to have this chat with you and look forward to 2023.
It has, and we actually met at a networking event probably like 8 or 9 years ago.
That's
So
right. Yeah.
yeah, you got to get out there and rub some elbows.
Belly to belly time, correct.
That's it, belly to belly. All right, Esther. Well, have a wonderful rest of your day, and again, thank you so much for your time today.
Thank you, Fernando. Take care.
Take care.